Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the fifth, hopefully the last part of chapter 18 presentation. Now, we have talked about revenue recognition at the point of delivery. We have talked about revenue recognition before delivery. Now we are going to talk about revenue recognition after delivery. What are we talking about here? Listen to this carefully. Here is a situation whereby you have earned, the company has earned the revenue, but you cannot recognize the revenue until you are able to collect. Why is that? Look at the rule. It said when the collection of the sales price is not reasonable, assured that revenue recognition is deferred. What does that mean? Here's the situation. We decided to sell $500,000 worth of goods to a customer that have consistently filed for bankruptcy. As a matter of fact, the customer just filed for bankruptcy, and we have enough evidence making us to believe that this customer might not even pay. Don't ask me why we decided to sell $500,000 to this customer. In such circumstance, the accounting rule is you cannot recognize revenue. It has to be deferred until you actually collect. Now, here are the methods of deferring revenue. Number one, installment sales method. Number two, cost recovery method. Number three, deposit method. Now, let's take a look at the first method, installment sales method. So here we recognize income in the periods of collection rather than in the period of sale, like I indicated. So we are going to recognize both revenue and cost of sales in the period of sale, but defer gross profit to periods in which cash is collected. That sounds confusing. Let's take a look at the implementation of that. First of all, I want you to know that the installment sales method is not an acceptable method. So we use this only in a special or extenuating circumstance, because it is based on a cash basis of accounting. So here is the application of the installment sales method. In the year 2014, we sold $200,000 worth of stock to a customer, but we are not sure whether we are able to collect or not. So the cost of the installment sales is $150,000. The gross profit is $50,000. First of all, we need to calculate the gross profit rate, because we are going to use that rate as a basis for computing the gross profit realized. So we are going to talk about what that means. So then let's take a look at the facts. So in 2014, the gross profit percentage, or the rate of gross profit, is 25%. How do you calculate that? We divide the gross profit by the sales, and that will give you 25%. Same thing for 2015, 2016, we have 24% here, we have 30% here. Couple of things I want to draw to your attention really quickly that are very important. Number one, as you can see, in 2014, even though our sales was 200,000, we collected only 60, 100,000, 40,000, 2015, 2016 respectively. So we calculate the two issues I want to bring to your attention is the fact that we calculate the rate of gross profit for each year. And that percentage is used to calculate the gross profit realized in subsequent years relative to the cash collected for those years. So for example, in 2014, we collected $10,000 in 2014 sales. So we use the gross profit percentage or rate of gross profit for that particular cash. If we wind up collecting 2014 cash in 2016, we use the rate of gross profit of 2014 for the cash that we collected relative to that sales in subsequent years. So that is how it works. Now, let's take a look at the example here. So in this example, let's take a look at the journal entry. We debit installment accounts receivable to 200,000 and we credit installment sales for 200,000. Watch. Take a look at this. We did not debit accounts receivable. This is a special accounts receivable, so we have it properly titled installment accounts receivable, so that we can distinguish this accounts receivable from regular receivables, and we credit the installment sales for $200,000. Now, watch. We wound up receiving $60,000 in that same year, so we debit cash for $60,000 and credit installment accounts receivable for $60,000. Of course, assuming that we are using the perpetual inventory system, we debit cost of sales and inventory, right? You know, one transaction, one entry is to recognize the sales, the other entry is to recognize the cost of goods sold and recognize the reduction of inventory. So watch this. At the end of the year, remember, we have to close out the sales and cost of goods sold. Why so? Because we are going to defer the related gross profit. So how do we do that? Installment sales was originally credited. We now debit it for the same amount to close it out. Cost of goods sold was originally debited. We now credit it to zero it out or to close it out. So the $50,000 difference is credited to defer gross profit. And we report this as an unearned revenue, which is a liability on the income statement. FASB prefers that this is a contra account to asset. Right now, this is how it is treated in practice. Now, take a look at this. In 2014, we received $60,000 cash. All right? 25% of 60,000 is 15,000. So we are going to debit gross profit, deferred gross profit for 50,000. So we are going to reduce deferred gross profit for 15,000 and credit realized gross profit for 50,000. So only $15,000, we are going to recognize only $15,000 in the current year, even though we received 60,000. So the only gross profit that we are realizing in 2014 is $15,000. Now, of course, at the end of the year, when we do our normal closing, close out revenues into income summary, close out expenses into income summary, then of course the realized gross profit has to be closed out into income summary. So additional problem of installment sales method. You can go through this on your own. Presentation. Okay, so let's take a look at the last piece, the cost recovery method. This is another after delivery revenue recognition issue. This is very simple. What do we mean by this? Listen to this very carefully. You provided or you sold $100,000 worth of goods to your customer. So the sales price is $100,000. But your cost of what you sold is $20,000. Here we are saying that you are not able to recognize any revenue until you recover the $20,000 cost of what you sold. That is basically what the cost recovery method is all about. And they have an example here to illustrate that. You can go through that on your own. All right, not too much of a big deal. Now, let's take a look at the last method relative to after delivery. We call this deposit method. This is very simple. Here's a situation whereby the buyer give you a deposit. You are the seller, and the seller recognizes the deposit as a liability. So the seller does not recognize revenue or income until the sale is actually completed. All right. So, fortunately, we are going to talk about revenue recognition from franchise, okay? This is appendix 18A. I know you don't want to hear this, but it is important nevertheless. So, what are we talking about here? This is a situation whereby we have a franchise operation. In the franchise operation, we have two parties, the franchisor and the franchisee. A very popular franchise operation would be McDonald's. So McDonald's Corporation is the franchisor, and the individual that is given the right to operate McDonald's is the franchisee. And both parties have obligations to fulfill. Most of them, you know. So you can read all of this on your own. The most important thing here is for the franchise operation like McDonald's, there are two sources of revenue. Number one, sale of initial franchises and related assets or services that they are going to provide for the franchisee, and the continuing fees based on the operation of franchise. So McDonald's might ask all the franchisee to pay 3 or 4% of their sales. Okay, so those are the two sources of revenue for the franchisor. Now, let's take a look at an example of income recognition. The first one is the initial franchise fees. So, revenue is recorded here when most of what the franchisor is expected to perform has been completed. So we call that substantial performance. So here is an illustration of that. T-Pizza charges. Here, essentially, let's take a look at the journal entries relative to the initial franchise fees. Just to summarize, look at this. The franchisor received $10,000. The note was issued for $40,000. But we have to recognize the interest component of that note. So we credit the discount on notes receivable for that amount, and the difference of $41,000 is considered as unearned franchise fees. And that is basically it for the initial franchise fee revenue recognition. So again, there are quite a few examples here. You can go through this on your own, but this is not going to be heavily tested. So that is the end of chapter 8, presentation revenue recognition.